Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section E2, and this is an application topic. Calculate impairment losses to be recognized on investments reported at amortized cost in the financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. If you don't know much about our strategies, make sure you go check out our free 1-hour webinar training and sign up for that. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour. It is free, and we will show you how to pass the CPA exam effectively and efficiently without wasting months or even years of your time. We will teach you things like studying in the morning before you go to work, studying the questions first, like I said, making sure you review every day what you've already studied so you don't forget things like that. You're going to learn that in our 1-hour webinar, so again, make sure you go check that out. Also, just letting you know, in today's video, we will only be going over 3 questions, whereas SuperfastCPA Pro members will have access to the full 6-question video when we post it in the members forum. Most of the time, these YouTube versions are 5 questions long and the member versions are 10 questions long. This is a topic that I felt like we could cover in 3 questions, and you'll see why when we get into the questions. But again, you can get access to our full member versions if you become a SuperfastCPA Pro member, so make sure you go check out that webinar, and after watching that, you'll want to buy the Pro bundle and so on. But again, make sure you check out the webinar first. And with the Pro bundle, you'll get tons of awesome resources, again, including access to these full videos that are longer than these YouTube versions that you see here. With all that said, let's dive straight into the questions for this video. All right, here we are at question 1. And again, remember, we're going over fewer questions than we normally do for today's video because even though this is a little bit of a complicated calculation topic, there's not too many ways that it seems to be tested. So I just made a few different variations of the way it seems to be tested. And so that's why we're only doing a few questions instead of the normal 5 or 10. So let's go ahead and dive into this. One thing we always like to point out is that you should always read the last part of the question first to give yourself context for what you need to look for in the rest of the question. Now, again, it doesn't always help, especially if you're doing a lot of the same questions in a row, but the reason that you do this is because it's a good habit to be in for test day, because you're going to be seeing tons of different questions on tons of different topics, and if you've learned what you need to know, you can read that last part of the question, it'll give you context, and you'll be able to apply your knowledge more quickly without wasting time reading through the whole question, getting to the last part of the question, and then having to reread the whole thing because you didn't realize that was what the question was asking. So that's why we do that. Let's read the last part, and then we're going to read the rest of it. Calculate the impairment loss to be recognized if the expected future interest payments are now $3,000 per year. Okay, that's some good information there. A company purchased a 5-year $100,000 bond at a discount for $95,000 with an annual coupon rate of 6% payable at the end of each year. Due to the declining credit quality of the issuer, the company determined that future interest payments will be less than expected. There are 3 years left until maturity, and the carrying amount of the bond after 2 years of discount amortization is $97,000. The following present value factors are provided. So we have a present value of $1 at 6% for 3 periods of 0.8396, and we have a present value of an ordinary annuity of $1 at 6% for 3 periods of 2.673. So again, with all that, we have to calculate the impairment loss, also knowing that the future interest payments for the remaining 3 years are going to be $3,000 a year. Now, if you've never seen anything like this before, or if this is something that confuses you, which, if I'm honest, this is something that definitely confused me when I was studying all this present value stuff, I hope that in this video we can kind of show you, at least for these specific question types, how to do it. It's not too difficult, especially because usually you're given the present value, so all you have to know is what to do with it. So anyway, if you know how to do this, that's great. Pause the video and try it yourself. If you don't know how to do it, that's okay. We're going to dive straight into the answer because, again, we're using the questions to learn what we need to know. So let's go ahead and go to the answer. All right, here we are. The answer is C, $5,021 is the impairment loss. So let's walk through this. If you've never seen anything like this before, we're going to explain it all right here. To calculate the impairment loss, and again, we're dealing with amortized cost investments, the present value of the expected future cash flows must be compared to the carrying amount of the bond. And that's the amortized cost, by the way. If you watched the previous video, we talked a lot about calculating that carrying amount, which is the amortized cost of these held-to-maturity bonds. So again, you are comparing the amortized cost or the carrying amount to the expected future for cash flows, which is the present value. So with all that, that's what we do. Now we're actually going to do the calculation. So first we have to figure out what the present value is. And there's 2 parts to this when you're calculating the impairment loss. First, you have to figure out the present value of the principal, and that's the one where you use just the present value factor for 3 periods. The one that doesn't talk about an annuity. It's just the present value factor for 3 periods at 6%, That's the 0.8396. We multiply the principal of $100,000 by that 0.8396, and that gives you $83,960 of the present value of the principal in 3 periods. Now, we also have to calculate the present value for the interest payments. And it was told to us that for the remainder of the time, the interest payments are going to be $3,000. You're not always going to be given the interest payment straight up. You might have to calculate it. But in this case, we know that it's $3,000 for the remaining years. So the present value factor for ordinary annuity for 3 periods at 6% is 2.673. So we use that to multiply the interest payments by, and that gives us $8,019 of present value for the interest payments for the remaining 3 periods. So the big thing here that you need to realize how to do, need to remember how to do, is you need to apply the present value of $1. It doesn't mention anything about annuity, just the present value of $1. You apply that one to the principal, and you apply the present value of an ordinary annuity of $1. You apply that to the interest payments. So just remember that, especially because basically the principal is always going to be bigger than the interest. So take the smaller number, the smaller decimal, which, maybe that's not always the case, but probably most of the time that's going to be the case. Take the smaller number, apply it to the principal, take the bigger number, apply it to the interest payments. And that's kind of a good rule of thumb that you can use there. Anyway, so we go down here, we add the $83,960 present value of the principal to the present value of the interest payments of $8,019, and that gives us the total present value of the expected future cash flows of $91,971. Now, since we know this, since we can tell that this is less than the carrying amount of the bond, again, meaning that we are expecting to get less money than the bond is currently carried at, that means there's going to be an impairment loss. So we subtract the total present value of the expected cash flows from the carrying amount of the bond. Again, that's the amortized cost of the bond. And that gives us $5,021 of an impairment loss. Because again, our future cash flows are expected to be lower than what the carrying amount is right now. And the reason we're only doing 3 questions in this video is because really it seems like most of the questions you're going to be seeing about this are quite similar to this, just maybe with some slightly different variations, which is why we're going to do 2 more questions to show you some different things that might happen. But overall, this is pretty much what you need to know how to do. You need to know how to calculate the present value of the principal, calculate the present value of the interest, compare it to the amortized cost, and that will give you the impairment loss for amortized cost or held to maturity investments. With all that, let's go to question 2. All right, here we are at question 2. Calculate the impairment loss to be recognized based on the reduced interest payments. Okay. A company purchased a 4-year $120,000 bond at par value with an annual coupon rate of 5.75%, payable at the end of each year. After 2 years, due to the issuer's financial difficulties, the company now expects that the remaining interest payments will be $1,500 less per year than originally anticipated. The effective interest rate remains 5.75%. The following present value factors are provided. Present value of $1 at 5.75% for 2 periods is 0.8945, and the present value of an ordinary annuity of $1 at 5.75% for 2 periods is 1.8334. So go ahead. I think you could probably figure this out just based off the previous question. Do it yourself, try it out at least, and when you're ready, come back, we'll look at it together and kind of see what the difference was in this different variation of this question type. And again, come back when you're ready, we'll look at it together. All right, here we are. The answer is C. $2,760 is the impairment loss. So now that we see the answer, $2,760, let's scroll down just a little bit more so we can see the full explanation all at once. So this one is a little bit different than the previous one because we were not given how much the interest payments are going to be for the rest of the terms. We're just given that we're expecting it to be this amount less for the rest of the terms, but we don't even know the original amount. So we have to figure out how much the interest payments were expected to be at the beginning, and then we have to take into account the $1,500 left. So what you do is you take the purchase price of $120,000, multiply it by the 5.75% interest rate, and that gives you $6,900 of interest annually. Now it says that due to the change in expectations, they now expect to receive $1,500 less than that for the remaining interest payments. So $6,900 less $1,500 is $5,400. So this is how much they're expecting to get each interest payment from now on. And so we're going to use that in a little bit. Now we have to calculate the present value of the principal, which again is the $120,000 multiplied by the present value factor for the remaining 2 periods at an interest rate of 5.75%, and that's 0.8945. So you multiply that by the $120,000, and that gives you the present value of the principal. That's $107,340. And notice in this question, it said par value. It was purchased at par value. So there's no amortization that's happening over the period. So you want to make sure you pay attention to that. Even though this is a held to maturity bond, or a held to maturity investment, the amortized cost might still sometimes be just the purchase price, because sometimes you can purchase it at the par value, so there was no discount or premium. So that's the amount that you keep using, $120,000. So that's the present value there. And so now we can calculate the present value of the adjusted interest payments, and that's $5,400 because we adjusted it for the remaining time. We multiply that by that present value factor of ordinary annuity for 2 periods at 5.75%, and that's 1.8334 multiplied by 5,400, and that gives us $9,900.36 of the present value of interest payments for the rest of the remaining term. So we add those together. That gives us the total present value of the expected cash flows of $117,240.36. Now we compare that to the carrying amount of the bond, which again is the amortized cost, but in this case, since it was purchased at par and no premium or discount amortization applies, it's still the $120,000. So you compare the two, and that gives you the impairment loss of $2,759.64, or really, rounded up to $2,760. That's how you figure out the impairment loss. Again, quite similar to the previous question, we just had to do a little bit more work because we had to figure out the actual original interest payment and then subtract the amount that they're expecting to get less each period. But then from there, we were able to do pretty much the same thing. Calculate the total present value of expected cash flows, compare that to the carrying amount of the bond, which is the amortized cost, and that will give us the impairment loss. All right, that was question 2. Let's go to question 3. All right, here we are at question 3. Calculate the impairment loss to be recognized on the adjusted interest payments. Again, not super helpful in this situation, but it is a very good habit to be in, so make sure you do that. A company purchased a 5-year, $187,500 bond at a premium for $193,750, with an annual coupon rate of 6% payable semi-annually. After 3 years, due to the issuer's deteriorating financial condition, the company now expects that the remaining interest payments will be $1,200 less each period for the remaining term. There are 2 years until maturity, and the amortized carrying amount of the bond after 3 years is $191,000. The following present value factors are provided. So present value of $1 for the remaining periods is 0.8885, and the present value of an ordinary annuity of $1 for the remaining periods is 3.7171. So again, with all that information, we have to calculate the impairment loss. This one's a little bit different because we have semi-annual interest payments, but pretty much everything else I think you could figure out. Think through this. We've done 2 questions quite similar to this. And again, I think that they're all going to be decently similar to this if you ever see anything like this. So pause the video, do it yourself, come back when you're ready, and we'll look at it together. All right, here we are. The answer is C, $7,958 is the impairment loss. Very similar to the previous other 2 questions. There's just one other thing that changed, which was the semi-annual payments. So let's go ahead and scroll down to get a better look at the full thing. Okay, there we go. Now we can see the full explanation. Let's calculate it all again. Again, we have to figure out what the original interest payments were to then figure out what the adjusted interest payments are so that we can then figure out the present value of the interest payments and, of course, the present value of the principal. So the bond's annual coupon rate is 6%. So the original annual interest payment is calculated as you take the par value, which is $187,500, multiplied by 6%, and that gives you $11,250 of interest. But since it told us that they have semi-annual interest payments, you divide $11,250 by 2, giving you $5,625 per period or per semi-annual interest payment. Now that we know that, and if you remember, it said that it was going to be $1,200 less per period, not per year. So $5,625 less $1,200 is $4,425 of interest paid each semi-annual period. Now we can figure out the present value of everything. So we go down here and calculate the present value of the principal. And remember, this is based off of the face value of the bond, of the investment. It's not going to be based off of the amount that you paid, such as the premium or the discount amount. It's based off of the $187,500 face value. So you multiply that by the present value factor that was given. That was 0.8885, and that's $166,593.75. That's the present value of the principal. And now that we also figured out up here the semi-annual adjusted interest payments, we can multiply those by the present value of the adjusted interest payments. That was the factor that we were given. We multiply it by 3.7171, and that gives us $16,448.17 of the present value of the interest payments for the rest of the periods. So we add that all together, $183,041.92. That is the expected present value of the future cash flows, or the expected cash flows. So now we can compare that to the amortized carrying amount of the bond, which was given to us, $191,000, and that gives us an impairment loss of $7,958.08, and you round that to $7,958. So with all that, we've gone over 3 questions teaching about this. Again, they were all quite similar, just a few different things in each question. But with that, before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions, you will notice the things that keep popping up. You see 2 or 3 or 4 questions trying to teach you how to calculate an impairment loss with maybe semi-annual payments. Or maybe you see 2 or 3 questions teaching you how to calculate the impairment loss when the yearly interest payments are expected to be reduced for the remainder of the period, or whatever the case may be. You notice the things in these questions that are obviously popping up multiple times, and so you know that these are the important topics that you need to know for the exam. So you take a moment after or during your studying, and you write down these pillar topics kind of as a summary in your own words of what the most important key or pillar topics were, so that you know them. And as you do this each day, you will be building the most important topics for the exam based on what you've learned from the questions. With that, let's go to the pillar topics for this video. All right, here we are at the pillar topics. And again, this is kind of a summary in your own words of what you learned from the questions that day. Now, for the impairment loss calculation, if you didn't notice this pattern throughout all of it, an impairment loss is recognized when the present value of expected future cash flows, and again, we had to do that with the principal and the adjusted interest, is lower than the investment's amortized carrying amount. And it kind of goes without saying, but I'm going to say it. If the amortized carrying amount is less than the expected future cash flows, then there's no impairment loss. So don't get confused by that. Don't get tripped up by that if for some reason you see a trick question about that. As for the present value factors, by the way, these are going to be given to you. I would highly doubt it if you ever had to calculate this, but you need to know how to use them. You use the appropriate present value factors for the remaining periods to discount the expected future cash flows, which may include adjusted interest payments due to changes in expected cash inflows. And a big thing that you need to know how to do is you need to remember which of the factors is applied to what. Remember, the present value factor, not of an ordinary annuity, just the present value factor of $1, that's what's applied to the principal, whereas the present value factor of an ordinary annuity of $1, that's applied to the interest. So remember those 2 distinctions there. That's almost one of the most important things you need to know for this type of topic. Next, when it comes to adjusting for changes in interest, if future interest payments are expected to be lower than initially agreed, adjust the expected cash flows before calculating their present value to determine the accurate impairment loss. So you want to make sure you know what the future interest payments are going to be before you calculate the impairment loss. And finally, for the amortized carrying amount, and we talked about this in a previous video, for bonds purchased at a premium or a discount, use the amortized carrying amount at the time of impairment to compare against the present value of adjusted cash flows to determine any loss. So you're not using the principal amount, you're not using the par value to calculate the impairment loss. Now you do need to know the par value to calculate the present value of the principal, because again, you're using the par value to calculate the present value of that par value of that principal. But when it comes to calculating the impairment loss, you compare it to the amortized carrying amount. So just remember that. And with that, those were the pillar topics for this video. And that is the end of this video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Make sure you sign up for that. It will be so worth your time. Again, it's only 1 hour, it's free, and we will teach you the key ingredients to passing the CPA exam. Things like, again, studying in the morning, studying the questions first, reviewing every day, and other things we will teach you in that webinar. So again, make sure you sign up for that. And remember that SuperFast CPA Pro members will have access to the full videos of these YouTube versions. In today's video, we only went over 3 questions, so the member version of this will go over 6 questions. Typically, it's a YouTube version of 5 questions and the member version of 10 questions, so that members can get more practice. And of course, they not only have access to these videos, but access to a whole bunch of other awesome resources. So make sure you become a SuperFast CPA Pro member. And with all that, if you like this video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next